Outside or inside, this is real, but you're looking at here. Interest rates backing up to 2.93%. We had got a little bit shy at 2.95% on a 10-year note. Again, as I say, just itching for 3%. Whether that represents a seminal level at which people then say, all right, that's it. I want the safety of both, Treasury notes and bonds backed by Uncle Sam, because 3% guaranteed by the U.S. government is better than potluck right now in the stock market. The read from Wall Street Journal Global Economics editor John Hilsenrath. John, what would happen if we get to that, if we get to 3%? Now, a lot of this based on this strong news and economic news and other developments, normally the stuff that people would welcome. But will this also hasten a move from stocks to bonds? It'd be bad for stocks.
Well, I mean, I think one of the things that we're seeing this week is people, because the earnings numbers have been pretty strong, people are moving out of bonds and into stocks, and that's pushing the yields up. You know, I think rising yields in this environment ought to be seen as a positive sign, a sign from the market that, you know, investors think the economy is improving, that inflation, after running below 2% for several years now, is finally getting up to the Federal Reserve's target. So, you know, I think it's really a vote of confidence in the economy. You know, that's not to say there won't be some negatives. So one of the things that happens when rates rise is that mortgage refinancings decline, and, you know, it puts a hit on the housing market. So, I mean, there will be some effects from that. But all in all, I think it's a vote of confidence for the economy.
I'm reminded of, like, you remember Peter Lynch, the great investor, who said that sometimes you have to see good news for what it is, good news, and there are these threats and offsets of it. For example, as you said, higher rates in housing and the rest. But by the way, in housing, we have not seen that impact in a dramatic way. Home prices, for example, in and out of multi-year highs. So what do you think's going on?
Well, I mean, housing inventories are really tight. There was, you know, after the building boom of the mid-2000s, there was just a collapse in building, and we're still catching up to that. And, you know, so we see inventories at exceptionally low levels, and that's putting upward pressure on prices. I mean, prices still, you know, on an inflation-adjusted level aren't back to where they were during the boom. So I think there's room to run on that front. You know, the one other thing I'd say about interest rates is, you know, your segments that you have going on right now relate to each other. You were just talking about $70 a barrel oil. I think that's one of the other reasons why interest rates are rising right now, is because we're seeing oil prices go up, and those two markets tend to move in tandem.
And they certainly aren't today to that point. That's a very good observation. John, always having you. Thank you very, very much.
Great to be here. Thanks.